Good day. Today we are going to talk about the bank reconciliation. So, what is a bank reconciliation? So, when we're talking about the word bank reconciliation, it is when we are comparing our cash transactions. Okay? It is when we are comparing our cash transactions transactions with the bank statement. Now, why are we doing this? It is because we want to identify if there are any errors or omissions. That is the reason we are doing the reconciliation. It's because we want to identify any errors or omissions. It can either be made by us as a business or it can be made by the bank. Let me say it again. Bank reconciliation. It is when we are comparing the cash transaction of the business with the bank statement. So you know that the bank statement you receive it in the bank. So after receiving the bank statement from the bank, we are then going to compare it with the transactions of the cash from the business. That is CRG and CPG. Obviously, the transactions there they must be the same. If they're not the same, it means we need to go and correct something because it means maybe there's an error or there's an omission. Now, let's continue. So, the importance of the reconciliation monthly. The importance of the reconciliation monthly. Why are we doing the reconciliation monthly? Like I said, we want to identify the errors and omission. That is why we're doing the reconciliation monthly. Like I said, bank reconciliation, we are comparing the cash transactions with the bank statement. So if we are doing it monthly, it means that we can easily identify the errors and omission early. That is why it is important to do the reconciliation monthly. Now let's look at this one. Accounting entries must be accurately recorded. Okay? Cash received is deposited and payments made electronically must be checked against the bank statement to ensure. So they're saying the cash received and deposited, it must be checked against the bank statement. Meaning that if we receive the check, if we receive the money, right? If we receive the money, then we have recorded it. We must check it against the bank statement. Okay? We must check it against the bank statement because let's say, for example, the customers they come and buy the goods from me as a company, and then I have received the money. So I take that money and then I go and deposit it to the bank. So once I have received the bank statement, I need to check if that money is there in the bank. So I need to check it there in the bank statement. So that is what I'm saying here. Like I said above, we are comparing the cash transactions with the bank statement. So even the payment, if the business made a payment, then payment is going to be recorded in the CPG. So once the bank statement comes, the business needs to check if that payment is appearing there in the bank statement. If it is not appearing, so the business needs to identify that what is it that happened. Was there an error or what? Okay, so we need to ensure that all deposits are correctly reflected on the bank statement. So I've already explained it. We ensure that all the EFT payment made were authorized. We check that the EFTs that we have made or the payment that we have made, are they appearing? Okay? And then all the outstanding payments and deposit are monitored. Now, what does this mean? So if they're talking about the outstanding payment and outstanding deposit, so the outstanding payment and the outstanding deposit. So these two. Let me start with the outstanding payment. Outstanding payment. It is when the business has made a payment. So the business have made a payment and they have recorded that payment in the cash transaction. But that payment, it is not appearing in a bank statement. So the business has made a payment and they have recorded it in a CPG, but it is not appearing in the bank statement. So that check, it is called an outstanding payment or an outstanding check. Okay? So the business needs to monitor that payment. That is it now appearing in the bank statement? Same thing with the deposit. The business needs to monitor these two. But I've made a video where I've explained these two, outstanding payment and outstanding deposit. Just go and look at that video. And then ensure that all errors ensure that all errors or unauthorized transactions are detected seamlessly so that the necessary corrections and investigation are done immediately. So that is what the business needs to do. It enables a business or individual to keep track of. So they're saying that doing a reconciliation, it allows the business to keep track of the bank charges or the service fees. So having a bank reconciliation, we can see that here are our bank charges. Because whenever we're doing or whenever we're using the money in the bank or whenever we're making a deposit or we're receiving money, there are charges there. So by doing a reconciliation, we can see those charges. And then we have it keeps the track of electronic transfer made by a business or a person. So sometimes a debtor or someone, they can pay us and then they don't tell us that they've paid. So by doing a reconciliation, we will only identify that in that time that no, someone has paid us. But if we don't do a reconciliation where we are comparing, we will not see that. It makes us to be able to keep the track of the interest on overdraft. So we can be able to see if we have the interest on overdraft that we have been charged. Interest on overdraft, it is also called interest on debit balance. Then we also have the interest and on the current account or interest on credit balance. So this is what we are doing when we're doing the reconciliation. We're just doing all this.